Coming up on today's show, stocks finished slightly higher led by the Dow Jones, on the back of more cooling inflation data, better than expected retail sales, Target surges over 17% on the back of earnings, and the latest portfolio moves from billionaires like Bill Gates, Ray Dalio, and Warren Buffett. Hey, what's up guys? Hope you're doing well. Welcome back to the Click Capital Daily Market Show. I'm your host Jared. And if you haven't already, smash that subscribe button as I do these videos every day after close to keep you updated on all the latest financial market news, data and charts. And so while we finished higher today, it was a bit mixed out there. You can see the breadth was quite checkered across the board. Did see a little bit of weakness in tech, utilities and energy. Then it was mostly just patches of green all over the place, with a few standouts like Intel, Tesla, Disney and Target, which I'll all get into on the charts a bit later on, along with my analysis on the S&P 500 and whether I think we're due for a pullback here or not. And it was actually the Dow Jones Industrial Average that won today, up 0.53%, and every other index finished higher, but the tech only slightly 0.08%, right near its year-to-date highs as well. And we'll come back and do a bit of technical analysis on this chart. First, let's just dive into the news and data for the day. And the economic data we're continuing to get is just more music to the ears of the stock market. Got another sign inflation's coming down with a drop in the producer price index, a bit more than expected, adding to the soft landing narrative for the economy and stock market. And that's the US producer price index falling 0.5% in October, and that's down from a 0.4% increase in October, and that was the largest decrease since April 2020, and a lot better than what economists had forecast at a 0.1% advance. And just looking at a one-year chart, at the PPI month-over-month growth, that was the biggest surprise we've had in a year, and only the third reading we've had at negative 0.5%. And there's a look at the 3-year chart. You can see that's been in a downtrend. Also helping a Goldilocks scenario for the stock market was retail sales data coming in today, and even though it declined month-over-month 0.1%, it too came in better than expected, as economists are expecting retail sales to contract 0.3%, and another sign that the US consumer is holding up really well. And there's a look at monthly US retail sales over the last year and a half, and so the lowest reading we've got since March, but nowhere near the contractions we had in late last year, early this year. And so now we've got a situation where unemployment is holding up well, spending's holding up okay, and inflation continues to come down. They're all good reasons for the bulls to get excited. And adding to that is one of the country's biggest retailers, Target, coming in with earnings per share well above estimates and up 36% from a year earlier. Even though total revenue fell 4.2%, they managed to get a material improvement in profitability by better managing their inventory, gross product margins, and just overall business efficiency. And the market absolutely loved that, and getting a real strong dead cat bounce here today after the stock had been beaten down quite considerably this year. Kicked off with some controversy about some products it was trying to sell to kids earlier the year. The stock had traded at $181 a share back in early February, and then it was just early last month that it actually got down to $102 a share, and it finished the day up 17.7%, with earnings coming in at $2.10 a share, well above the estimate of $1.47. That's a 42% beat, and it's currently now sitting at a $60 billion market cap with just under a 4% dividend yield. And moving on to bonds, we just saw another big jump in treasury yields today on more volatility in the bond market. And that's ahead of a $16 billion 20-year auction tomorrow. And we can see that in the daily chart of the 2-year yield climbing just under 8 basis points, which doesn't look like much after yesterday's huge 20 basis point fall, and a little bit of a climb back in the 10-year. However, it's still in a bit of a short-term downtrend here, and I'll be looking for it to find support around this 430 level, which is around the bottom of this buy-sell band. And unless we got any nasty surprises in the market, I would be surprised if the 10-year took out 430, and very surprised if we traded anywhere near 4% until we're definitively looking like we're going into a recession. And looking at Fed fund futures, that market is not even given the slightest of probabilities that the Fed will hike again. Actually saying now for sure 100% that the Fed is done, and currently given a 1 in 4 chance that they'll even cut with a more than 50% chance that they'll cut come May. And so looking at this market, they are forecasting a recession by middle of next year. But if you look at stock market analysts' expectations for earnings and just the price action in the stock market itself, it is not forecasting a recession 4, 5, 6 months away at all. And there is the big disconnect going on in the markets at the moment. Moving on to commodities, and we saw the price of oil fall again as US crude supplies mark a 2-week climb of more than 17 million barrels. So we're seeing some increasing supply as consumers pull back at the pump, and this should really please the Biden administration and Americans in general, as a higher oil price threatens to bring back inflation and increase the chances the economy goes into a recession sooner than later. And just looking at the daily chart of crude oil futures, you can see that slight turn back down. Today over 2%, now sitting at $76.66 a barrel. And we got a little bit of a support zone around this $74 a barrel. Be looking to see whether that holds. And just taking you out to a weekly chart on crude, Looks like we could be back into some more sideways action for the foreseeable future, as the market's pretty much assigning no chance that what's going on in the Middle East will disrupt supplies anytime soon. But the chief global market strategist at JP Morgan still favouring commodities over bonds and wants a stock market rally is poised to fizzle. That's Marko Kolanovic, who's overweight commodities outside of gold, given weak positions and geopolitical risk. He said concerns with US Treasury supply have not been resolved by recent developments, and he thinks investors are too optimistic equities can run higher amid a slew of headwinds. He said this month we take profit on our long duration exposure in government bonds given their strong rally, increasing supply, dovish Fed pricing, and increased investor positioning. We use the cut in bond allocation to fund an increase in our commodity allocation, given still high geopolitical risks and the significant sell-off and weaker positioning in energy, and we incrementally shift our within commodity allocation into energy. So he basically thinks oil is going to outperform over the coming months. As bonds have had their rally, the Fed being done is going to counter that, and stocks have got ahead of themselves, is basically what he's saying. And it's moving on to crypto. We've got another rally up in Bitcoin, along with Ethereum and altcoins, getting a bit of bullish breadth in the crypto market here, with one analyst saying Bitcoin is going mainstream and the bear is behind us and that the good times are here. And maybe he's right, because technically speaking, we have some good developments in the price of Bitcoin. Appears to be holding that $35,000 level, potentially turning that prior resistance into new support. Ethereum's still got a little bit of work for it to break out of its big resistance zone. And just taking you out to a clean monthly chart of the total market cap of cryptocurrencies, it's currently at 1.4 trillion. That's well off the all-time highs of November 2021, when it briefly touched exactly 3 trillion, went into a huge drawdown over the next year, getting down to 820 billion November last year. And now we're working towards it almost doubling and a bit of a bounce here. And I'll just switch this over to a logarithmic chart. That gives you a bit of a better idea as what the crypto market as a whole has done. It's funny to think just back in 2015, the whole crypto market only had a valuation of 3.3 billion. And here we are 8 years later at 1.4 trillion. It just goes to show you, and something I've seen time and time again in studying markets and in my 20 years of trading, is how bigger returns controversial things can deliver. And over that period of time, Bitcoin and crypto has been highly controversial, with a lot of people having been skeptical of it, myself included, and then looking across other controversial things and the huge returns they've delivered. Things like Tesla and Elon Musk, with the price of Tesla in that same time going from split adjusted $15 a share to $242 where we are now. Google with its search monopoly going from $27 a share to $134 a share. And so in other words, controversy can pay. And so if you think about what are some real controversial things right now, one of the big ones that comes to mind to me is that of cannabis, and how beaten down the sector has been over the last couple of years, looking at the MSOS ETF. And this is one sector I think could offer a huge potential returns over the next couple of years, as I see its legalization as being inevitable, and it having the potential as an industry to have a greater market cap than alcohol and tobacco combined. Once society as a whole realizes it's a much healthier alternative with a lot of medical and other applications as well. Moving on, something I found interesting today was some new positions that some billionaires have taken, namely Bill Gates and Ray Dalio, purchasing small stakes in NVDA at these high levels and valuations. And that's the Gates Trust, where he keeps the bulk of his fortune, currently at around 39 billion. And for years and years, he kept that around 20 or so positions. However, in the last quarter, he significantly diversified from 23 to 74. Adding a lot of small positions, NVIDIA being one of them. What was also interesting is he disclosed new stakes in Apple, Meta, Amazon, and Alphabet. And just sticking to a clean monthly chart of a composite index of those stocks Bill Gates added, Apple, Meta, Amazon, Alphabet, and NVIDIA. It's just interesting to see one of the wealthiest persons in the world betting on mega cap tech after they've increased 15-fold over the last decade. So he obviously thinks they can go a lot higher. Maybe he's betting on their monopolistic qualities as being more defensive going into the future, and maybe he doesn't expect another 15x gain over the next decade, rather thinks they'll hold up better than the market and be able to defend their earnings and positions in the industries they compete in. So I thought that was interesting. But just moving on to economic data, got some inflation data coming out of the United Kingdom, similar to America, coming in a bit better than expected. The headline inflation coming in at 4.6 year over year versus 4.8. France's inflation year over year 4% as expected, and Italy a lot lower, coming in at 1.7%. There's the retail sales in the States coming in better than expected, and the producer price index coming in a lot lower than expected. And there's that big jump in gas and crude oil supplies. Looking out to tomorrow, we've got the weekly jobless claims, along with some industrial production and a few Fed speakers. Looking at the fear and greed index, we've got a bit of a jump here today, going from 47 to 53. almost in the greed zone. Stock market just starting to get on better footing. And more strange action and corporate insider activity. After getting a big jump on Monday's data, we got a big fall yesterday with sales only slightly eclipsing purchases, 78 to 67. And just diving into the charts, there's my institutional buying percentage indicator. Now going into the bearish zone at 40%. We got the S&P 500 oscillator still really elevated there at 64. And basically that's telling me this market is close to putting in a short-term top, and we are quite overextended and overbought here. Doesn't mean we can't keep rallying for a few more days like we saw back here in mid-July. However, I'm not initiating any new long positions at these elevated levels. I'd rather wait for a pullback, and I can see that in my regular chart as well. Now I've got the fourth reversal signal in a row. We went above the buy-sell band today and pulled back on a really narrow range day, and this is a bit of a resistance zone where the market has turned before. So we may get a little bit of a pullback here over the coming days, but stick with me because I'll come back to this at the end of the video. It was a flat Wednesday looking across international stock markets. None of them moved more than 1% in either direction. Pretty quiet day in volatility as well. VIX sitting flat just above 14. Option dealers really not that worried. Actually willing to write premium at a lower implied volatility than realized volatility. But bond market volatility is still really elevated compared to stocks. The move VIX spread currently near all-time highs. And another big day on the options market. 45.3 million contracts traded, 57% of them calls, with almost half of them expiring in the next. So a lot of people buying call options, betting on prices to keep increasing over the next couple of days going into next week. And that's when we've got short-term breadth really extended here as well. 87% of stocks above their 20-day average. And when you see short-term breadth this extended, we can be close to a pullback. And we've got just about half of stocks almost above their 200-day average now. But a little bit of a continued improvement in net highs versus net lows. 81 to 3 on the NYSE. 98 stocks making new highs in the Nasdaq versus 20 lows. Continued move up in high beta stocks versus low volatility stocks. And there's a look at the spread between consumer discretionary stocks versus consumer staple stocks. Currently near year-to-date highs, and that spread's had a really good year on the back of those consumer staple stocks being whacked really hard and discretionary stuff still holding up okay. There's the inflation expectation spread. We can see that sharp move down yesterday and over the last couple of weeks, coinciding with the Fed fund futures saying for sure that the Fed is done, even though the 2 years pulled back a little bit, sitting at 491, and the 10 years still holding up. Like I've been saying, I expect long-dated yields to hold up a bit better than short-dated yields for the foreseeable future, unless we get a really horrible recession. And there's TLT pulling back 1.4% today. The longer we stay above this 50-day VWAP, the more likely that is a low. So dollar just trying to hold ground there above 104, and commodities pulling back slightly on what's otherwise been a low volatile day across markets. Over to stock sectors, it was meme stocks and ARK stocks. Like I said, the real high beta, high valued volatile stuff leading the way, along with another bounce in clean energy getting above its 50-day VWAP for the first time in months but couldn't close above it, and another good bounce in retail stocks up over 2% today on the back of target. Regional stocks finding another high today, and the loser being cybersecurity stocks after they've had a pretty good run, one of the best performing sectors this year on the back of geopolitical tensions, and gold miners coming in as the second loser and utilities as third. Over to stocks we track, there's the BlackRock barometer ripping up again, and what should be another good sign for the market here. The world's biggest bank, JP Morgan, holding ground pretty good, and the mega cap tech looking vulnerable to a pullback. There's Apple on its fifth consecutive reversal signal, looking pretty extended here, and Microsoft as well stalling out, which we typically see before a market turns. And just looking at my VWAP extreme indicator, we can see we're 10% above the 50-day VWAP, but we have got a little bit more extended than that over the past year. We have been up to 14%. However, that is relatively high, 10% gap. So a pullback could be expected here. Almost getting out to all-time highs today, just under $500 a share. We did get up to $502 a share after their last quarterly earnings. We'll get to hear from their earnings next week, but this is looking a little bit like a reversal pattern right here. Amazon as well did a big bearish engulfing candle, and Tesla managed to close that earnings gap. It's a little surprising to me to see the strength in Tesla after their really bad last quarterly earnings and compressing margins. And I'm really interested to see whether it can hold on to this gap. But I suspect, like a lot of markets, we're in for a bit more sideways trading, a bit more chop, messy up and down. Just skipping over meme stocks, we did see a bunch of green out there, as high beta does well. And just flicking through the major defense contractors, their price action continues to hold up after those gaps we got when the Middle East conflict first kicked off 5 weeks ago. And there's Intel breaking out to a new year-to-date high. If you've been watching my channel, you know I've been talking about this one favorably, as I think it's got a lot of tailwind behind it with the US government's mandate to increase domestic production of chips and rely less on Taiwan and China. And the CHIPS Act with funding is a good bullish catalyst for Intel, which had been beaten down the last couple of years. as NVIDIA skipped over them to take the lead in the industry. But Intel is still a big company with a lot of capacity to produce chips, and they just came in with a really good quarterly earnings beat late last month as well. So fundamentally and technically, Intel is looking good here. And just looking at those beaten down snack makers, they seem to be holding up okay. After putting in some bottoms last month, market got really worried about those new weight loss drugs. May have overdid it, as it normally does. And a nice little bounce in Walgreens, Macy's, and 3M breaking out to new highs again, with the telecoms holding up pretty good as well. Along with those vulnerable regional banks continue just to hang in there, and the big guys, Bank of America, Citi trading up strong, Wells and Schwab having a good day. Okay, back to the S&P 500. We're looking a little extended here at the top of my buy-sell band, the fourth consecutive reversal signal, and the DSI currently in an overbought zone. We don't have a divergence on the hidden divergence indicator yet. I'd say we're just in for a period of chop around 45.30, maybe back down to 4,400. However, there is still a lot of reason for the bulls to get excited here, and the market can typically go a lot further for longer than you think, so I wouldn't be surprised to get another big green candle taking us right up to year-to-date highs above 4,600, and that very well could be a bull trap, a fake out. We're already seeing a lot of people buying calls here, and I can imagine that would go up even more. Open interest on calls is near records, and this soft inflation data with the economy holding up, earnings coming in better than expected, and now we've got some bullish momentum. This could easily spill over, and we find ourselves at new year-to-date highs, possibly before the end of the week or into next week, as the market can still easily rally a couple of months before the Fed cuts rates, and that's what the bond market thinks the Fed is going to do. Saying by May next year, there'll be enough weakness in the economy to justify the Fed cutting rates, and then the stock market should roll over. However, as usual, we'll just have to play it day by day, keep watching the price action, and do our best to figure out what's happening and where we could possibly go from there. That's all I got for you today. Thanks very much for tuning in with Click Capital and sticking with me. Appreciate all your support, and I hope to see all you guys again tomorrow night. Cheers.